Hello investors, happy Friday. Welcome to Casual Friday at Cruise Asset Management. And today we're going to be talking about the VIX, the volatility index, or some people refer to it as the fear index, because traditionally when the stock market's selling off in a big way, the VIX spikes. But really what it is a measure of the volatility of the stock market. And quite often when the market is dropping, drops very fast, very quickly, rises more slowly. So you see a lot more volatility to the downside than you traditionally see to the upside. But when you do have big downside movements, you also have violent upside movements. So the largest upside swings we've seen have been in long-term down bear markets, right? So you've seen big upward spikes, but they almost always come in prolonged downturn markets. So here's a chart of the VIX. It's a year-to-date chart. And I have up here the average. You know what we can do is put on a max. Let's put on a max line too. So it hit a high of 82.69 and it's average around 30. Just to kind of give some perspective, and we're at 23. So you might say, well, the volatility is much lower than it traditionally is. So we're in good shape right now, right? But if we really look out over a 3-year, which is the volatility index is 18, or a 5-year, or even a 10-year period, the volatility index traditionally is kind of around this 17 number. And our average is being brought up because we hit the highest VIX level in 10 years. And really, if I go out over the maximum, we didn't even hit the same VIX level back during the financial crisis. So we hit our all-time high, or at least near-term recent history high of the VIX, which of course drives the averages up. So that's why the short-term average is quite a bit higher than the long-term average. So if we look at a 10-year average of 17 and our year-to-date average is 30, it seems to be we're underneath that, but looking at a longer-term average, we're really quite high relative to a longer-term average. Now, you see along the way, this 5 years, every once in a while, we'll see these spikes along the way. And I'm going to put on here a chart of, let's go back to year-to-date. I'm going to put on here the S&P 500 and put this on a different frame. So the VIX is on the top frame and the S&P is on the bottom, and they basically look like mirror images of each other. So as the S&P is selling off, the volatility is going higher. The S&P is usually the cause of the VIX and not vice versa. But what we will notice is over a period of time, if you start seeing these kind of spikes along the way, you see a decline. And traditionally we see periods of excess volatility, which might mean you're going to see periods of sell-offs from time to time. And we've had this VIX coming down, coming down, coming down. So our volatility has been in quite a bit of decline. We're still relatively high over the long-term average, but a low VIX. So what I'm suggesting to you is at some point in the near future, we could see a spike in the VIX. As you see periodically throughout this chart, you'll see these spike ups above this level, or even if you're below here, you'll see a spike up here and there, which tends to correspond with drop-offs that you'll see in the S&P 500. So as you see a spike, you see a drop-off. A spike, you see a drop-off. So what I'm suggesting is we could be very well due for a drop-off or kind of a mini correction in the S&P 500. Just taking a VIX as a model, that we've been a little subdued, haven't even had to talk about the VIX for quite some time, which is exactly why I decided to create a chart on it, because I have this well, not even a feeling. We don't act on feelings at Cruise Asset Management, but if you're looking at the data over time, you generally see kind of a dampening out and then a spike up. So if that happens again, you're going to see a sell-off in the S&P 500. So we'll be watching things like this, like the VIX and a variety of other indicators, especially with the high multiples that we have right now. If you have a spike in the VIX or a little return to the mean in the multiples, you could see a spike in the VIX and a sell-off of the S&P very easily of 10 or 15% without really batting an eye. So we'll keep riding this wave while we can. You can see the S&P is above the February 19th all-time highs. So we're making new highs every time we make a new high in the S&P, but probably got a little over our skis. So we could be due for a little pullback, especially coming into the fall months where you see September and October have traditionally been volatile months and prime months for sell-offs. But as always, here at Cruz Asset Management, we're going to use the data to invest with the odds in your favor.